At the age of just 25, Warren Buffett established his first investing firm, the Buffett Partnership. Buffett's investing firm achieved returns of 29.5% on average between 1957 and 1969. The remarkable element of Warren Buffett's investing approach is that he uses quite simple methods to produce these large profits. Warren Buffett says you don't have to be a rocket scientist. In the game of investing, a person with a 160 IQ does not always perform better than a person with a 130 IQ. So the secret to getting huge returns is to be logical, stick to simple strategies, and maintain those plans under pressure. The 7 investment tenets that Warren Buffett employed to get such a high return are what I want to share with you. I can't promise that your return will be as good as Buffett's, though. After all, he is a very clever man who has dedicated his life to investing. But if you take Warren Buffett's 7 investment tips to heart, you'll noticeably boost your overall long-term return. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Buy business success, not stock gains. This rule was revealed to Warren Buffett when he first read Benjamin Graham's The Intelligent Investor, one of the greatest financial books of all time. Buffett would eventually look up to Graham as a mentor. One of the rules in the book was quite easy to understand. Buffett was persuaded by the idea that buying stocks implies owning a stake in a firm and that, in the long run, the stock will rise if the company performs well. Look for companies with a strong future, a sizable profit margin, a competitive advantage over the competition, and a positive customer reputation. It doesn't need to be complex. Stocks are a part of the company, and you will profit if their business is successful. Number 2. Most news is not actual news. Buffett may have this unpopular viewpoint, but most news you read has little to do with investments. As a matter of fact, news organizations like CNBC, news websites, and financial YouTubers are all paid to attract more views. They consequently do everything in their power to generate as much buzz or worry in order to garner those views so they may earn more money. You only need to pay attention to about 5% of that news. Buffett, however, asserts that investors typically permit the unpredictable and frequently illogical actions of their fellow investors to affect their own actions. Since there is so much discussion about the markets, the economy, interest rates, stock price behavior, etc., some investors believe it is essential to pay attention to experts. Even worse, they believe that it is imperative to take their recommendations into consideration. Avoid worrying about the commentators and the majority of the news. Just focus on the most crucial information. Number 3. Not everyone is trustworthy. I assume you are already aware of how crucial compound interest is as a financial concept. When you receive dividends or capital gains and allow them to compound and grow like a snowball, you can make a lot of money. But if you keep buying and selling stocks, you'll miss out on a lot of returns because compound interest won't have a chance to work its magic. They claim that timing, rather than simply time, is everything in the markets. When buying a stock, the secret to successful investing is to picture yourself owning higher quality businesses for all time. As a result, Buffett has owned shares of Coca-Cola, Wells Fargo, and American Express for more than 25 years. The great Philip Arthur Fisher once said, "The moment to sell is almost never, if the job has been done well when a common stock is purchased." Through the reinvestment of dividend and capital gain income, you can increase your wealth. As a result, timing the markets is crucial as opposed to trying to time them. As a result, you should be ready to hold onto the stock indefinitely. When you do your research before making a purchase, there is almost never a good time to sell. Number 4. Plan on holding forever. One of the best things about investing is that we are not in this alone. Throughout his career, even Warren Buffett has consistently picked up tips from and paid attention to other investors. He learned the fundamentals of investment from investing expert Benjamin Graham when he was younger. The good news is that we can learn from and listen to the great investors as well. When he got a little older, Charlie Munger was usually by his side to check to see whether he had the right perspective on things. We can see Warren Buffett's whole portfolio as well as the specific stocks he buys each year. Although Ray Dalio and Charlie Munger routinely express their views on CNBC, the most crucial thing is to listen to those we already know and trust. Do we really need to pay attention to that CNBC expert who is always talking about the next trend, or to that new YouTuber who is getting lots of views and who is advocating the purchase of Tesla stock? Do they understand investing? Do they know what the inherent value of each stock is? If you don't know and trust someone, don't listen to them. What I just mentioned doesn't mean you shouldn't take into account what other people have to say. Furthermore, today's investors, including Buffett himself, may utilize the internet to track the precise movements of many of the world's most successful investors in real time. Trust is the most important consideration in this situation. Should you believe a random marketer who is only attempting to get you to click on his affiliate link? Probably not. You ought to only pay attention to advice from those you already know and trust. Your needs should come first when selecting a suitable investment, not other people's expectations. Number 5. Know intrinsic value. The idea of understanding the firm you're investing in is very simple, yet few people actually do it. One aspect of Warren Buffett's portfolio that sticks out is how many of the companies he owns are really simple. As a company, you have Coca-Cola. They only sell soft drinks, but they've just started selling meals as well. The airline Southwest Airlines makes money by selling tickets. Furniture Mart sells furniture. Apple is a technology retailer that offers iPhones. Before buying a stock, Warren Buffett makes care to thoroughly understand the company, and you should do the same. If you're interested in cars, dig deeper and take Tesla, Ford, and Toyota into consideration. Amazon and Alibaba are worth checking out if you like online buying. If you appreciate the online world, have a look at organizations like Alphabet, which controls Google and YouTube. Almost every activity or interest imaginable has stocks available for purchase. Only invest in firms you can understand. Number 6. Understand what you're buying. The current status of the market makes this rule particularly relevant. The intriguing aspect of the current market position is that during the course of the past 11 years of our current bull market, equity prices have climbed by more than 300%. Everyone thinks they are stock market experts since everything has been going up and everyone is making money. Everyone gets greedy because they are confident and have good investment skills. What effect do you think this will have right now on stock prices? So, increase prices significantly. Stock prices increase as a result of increased investor interest, making it harder and harder each day to find a deal on the stock market. When making investments in these turbulent times, we must exercise caution and fear, and Buffett is doing precisely that. He has $214 billion in publicly traded equities and $128 billion in cash. That is a considerable amount of money. He is exercising extreme caution due to the state of the market. You may claim that he was scared. But as soon as stock market fear starts to set in, you can bet your bottom dollar that Warren Buffett's greed will take over and he will start buying up a lot of stocks when they are on sale. Number 7. Be fearful when others are greedy. If you don't follow this rule when it comes to investing, all the others are meaningless, and your strategy will fail. It is not worth an indefinite price, regardless of how great the company, the managers, or your understanding of the business are. Make sure the price you are paying is less than or the same as the item's actual value. Please give me a moment to explain. Let's say you want to buy a Lamborghini. There is no denying the outstanding quality and dependability of this car. There is no doubting that this car's designers gave it incredibly careful consideration and accuracy. However, the most crucial question is the purchasing price reasonable? Is it really $350,000 worth? Remember that neither a stock nor a car can have a limitless worth. No company, no matter how brilliant, according to Warren Buffett, is worth an endless price. Value is what you get. Price is what you pay. To comprehend the value of each stock, one must first comprehend its intrinsic value. I believe that these 7 principles are essential when it comes to investing. To realize that your stock is a part of someone else's company and that you would profit if their company is successful, you must have the right perspective. The majority of the information on those financial TV shows and among YouTubers is noise rather than actual news. For buying stocks, an infinite holding time is preferable. Never put money into a venture you don't completely understand. Be fearful when others are greedy and greedy when others are fearful, and only invest in equities at levels that make sense. If you follow these 7 crucial guidelines, you will outperform the majority of investors. This is it for today's video. What do you think of our video? Which rule do you like most? Let us know in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.